Please welcome your panel on Global Overview, a 2020 Perspective, moderated by Bloomberg News Correspondent Haslinda Amin.
Good morning. 20 years ago, Asia suffered a financial crisis. Investors fled, currencies collapsed, growth dissipated. Now, Asia is home to some of the strongest growing countries in the world, fastest growing countries in the world. And over the past 20 years, we saw the tech bubble collapse. We went from the World Wide Web to digital, to social media, and the smartphone revolution. And now we're talking about the fourth industrial revolution. And talk of globalization over the past 20 years has turned into discussions of trade wars, erecting barriers, erecting a wall. And traditional pillars of the open market, like the UK and the US, are looking pretty wobbly. What we're seeing right now is the fragility of globalization itself. So when we look back, what really are the lessons that we've learned? And when you look forward 20 years, how will they look like? That's what we hope to address today. Now, Piyush, let's start with you. When we take a look at the Asian financial crisis and the aftermath, and the countries that suffered the most, like South Korea, Malaysia, Indonesia, now that their foreign reserves are strong, their foreign debt has decreased, doesn't necessarily mean that lessons have been learned and that they can withstand future crises.
Well, I think some lessons were learned, and the outcome of the lessons is exactly what you cite. It was mostly a currency and a sovereign crisis, and in that period of time, countries rebuilt reserves from several years of current account deficits. We've had now 15, 20 years of current account surpluses. Foreign debt to GDP is down from 60, 70, 80% to 15, 20, 25%. The banking sector got better capitalized. Perhaps one of the bigger lessons, supervisors, regulators became more intrusive and started regulating more actively. And therefore, I think it's fair to say that countries in this part of the world today are far more sound than they were in 1997. However, if you look back at the fundamental issue, which is surpluses and credit creation, that lesson is a lesson that we as humanity never learned. You've gone through decades, centuries of surplus credit creation, creating crisis in different parts of the system. And so if we get down to basics of continuing to use credit to drive growth, the reality is a plus and a minus. The modern economy has been based on the notion of credit, and that does allow you to grow the pie. So it can be a good thing. On the other hand, too much of a good thing can be a bad thing. And that's what we saw in the 07-08 crisis. It was fundamentally a credit crisis of too much credit-fueled growth in large parts of the mortgage and the housing system in the US, which then spilled over. Have we learned the lesson that too much of credit, unsupervised and unregulated, can be a danger? On paper, yes. In reality, often no. If you look at the slew of regulation in the last 10 years, I think by and large it's beneficial, but it is narrow. It focuses on the regulated banking sector. The reality is a large part of credit creation today is outside the regulated banking sector. And whether it is the funds industries or whether it is the fintech space, much of that is not regulated today. And so could you wind up with another creation of a credit bubble? Sure.
Jean, I know you specialize in healthcare, biotech, and they were pretty much unaffected by the Asian financial crisis. But from an investor's point of view, what's the takeaway?
Yeah. So maybe I'll take the perspective more from the dot-com crisis, the dot-com bubble, because that really impacted the biotech and healthcare markets. That was a period of excess where the markets were getting very, very excited about the potential for a change in how biology was done. It was just very premature. I mean, when the human genome was sequenced in the year 2000, that was a sentinel event for the industry. But it took another 10 years for the industry to have the tools to be able to really capture the power of genetic sequencing and understanding biology at a level that they were able to discover new medicines. So when you think back to 1999 and 2000, when we had excess valuations of biotechnology companies in particular, it was all based on dreams of the future. Now that dreams are beginning to come true, but it was, back in that period, there was significant excess. And so the lesson learned is you always have to ground your analysis or your valuations of the companies based on a period of time in the future that's not 15 or 20 years out. So the enthusiasm was right. It was just very early. Maybe one thing to think about when you think about the industry in the year 2000 when the human genome was sequenced, the pharmaceutical and biotechnology industry went through a dramatic change over the next decade. So for the first time, patents expired at a dramatically faster pace than they had in the previous 20 or 30 years. So starting at about 2001 or 2002, you started losing your patents 80 or 90%. There's probably no other industry in the world where once your patent expires, you lose 90% of your revenues now in a month. So the industry had to completely adapt to be able to invest in the science. And that's what they did over a decade. The pharmaceutical industry adapted by, one, focusing their R&D efforts, by reducing costs to be able to invest in R&D, the new science of R&D, really focusing on the high innovation curve rather than just incremental innovation, and really investing in emerging markets. The growth of emerging markets in the past decade have really helped the pharmaceutical industry with their patent expirations and allowed them to invest.
I'll pick up on the dot-com. For now, though, Joachim, going back to the Asian financial crisis, were the right lessons learned? And although the circumstances leading to the 2008 crisis were different, why couldn't the lessons learned during the 97 crisis help prevent the 2008 crisis?
Well, I think that the big lesson in the 97-98 crisis was exactly that you need to have some reserves, you have to be careful about your current account, and countries they start to react to this, and for 10 years they build reserves. So when you had some countries in Asia, in Latin America, not everywhere, and at the same time you saw something that, yes, recurrent, which is when you have a deceleration in the economy, you try just to get more finance, more liquidity to try to compensate for that. In a way, we saw this in the US in the early 2000s. We had a deceleration after the Clinton years. And there was a loose fiscal policy and a loose monetary policy that allowed the build-up of that. When the crisis came into 2008, some countries were more prepared than others. And also the big change in 2008 was that the level of coordination was absolutely unique. The G20 took the leading role, and there was coordination of anti-cyclical policies, in some cases monetary policy, in case of Western countries. In Asia, of course, all the surge in fiscal policy investments in China. And these allowed to actually reduce a little bit of the shock, but has still made the consequence quite long-term. So lessons in tools from 97. Good macroeconomic policies pays. Lesson from 2007, you need to have more financial regulation. I think that the work of a Financial Stability Board, I represent the World Bank there, is absolutely fundamental. People sometimes don't realize the importance of getting these new rules exactly to tame some of the aspects of financial markets, and not only the banking sector, but shadow banks, also credit markets in bond markets, derivatives. I think that we are in a phase where a lot of new regulations have been designed, some already being implemented, and now we are taking stock of the consequence, both in terms of stability, but also ensuring that you're doing the right measure so that it doesn't hurt growth, and also that you understand the combined impact of the regulations in the different areas of the financial markets. It's a very complex thing, but I think it's essential to ensure and to keep a level of confidence for the next few years and foster growth in a very different structural say, environment that we can talk later, which is the persistent, say, imbalance between savings and investment, which in part due to technological reasons, demographic reasons. I think it's the main question today.
I'm curious about the prescription for the two crises. Totally different. For the Asian financial crisis, the IMF, the multilaterals, forced the non-performing banks to collapse. Funding was less than 10% of GDP. Whereas for the 2008 crisis, the Fed allowed a bailout of the non-performing banks, and funding was in excess of 50% of GDP. Is there a key takeaway in terms of how crises should be dealt with from the World Bank perspective, multilaterals, IMF perspective?
Well, I'd say that in '97, there was also a certain attention to avoid a generalized collapse. I mean, the IMF was active in providing support, including current account support. I mean, you think about Korea. But I think the magnitude of the crisis in 2007 required somewhat different changes in how to deal with too big to fail. On the other hand, as it happened past '97, there were some structural changes in the structure of the financial market, the architecture of financial markets after the crisis. And it was recently reminded by, for instance, Stanley Fischer, that we should not to undo these in a haste, because they're a very important piece to ensure the, say, the robustness of the whole economic framework of the globe.
Piyush, Jean, when you speak to people in the market and ask, is another crisis looming? A lot of them say yes, but they can't say when or where. If the right lessons were learned from '07, from '08, from '97 and '08, why aren't we able to say where the crisis is coming from and what the crisis will be like? Piyush.
Well, you know, I think this is like saying, could a meteor crash on Earth? Of course it could. So is another crisis looming is just a very open-ended kind of question. Sure, there could be a crisis where it could come from climate, it could come from temperature, it could come from anything. If your notion is there another financial crisis looming from excesses in credit,
financial crisis.
If you look at the history of banking in 200 years, you always have excess credit. You know, financiers have short memories, and particularly savers are always looking for returns. And you know, avarice and greed always trumps caution over a period of time. So will you find a lot of savings being misdirected into investments that don't provide adequate returns? It is not only possible, but likely to happen. You look at valuations in the markets today, equity markets, bond markets, every kind of financial asset class. It's hard to argue that many of them are not inflated. Most of it is liquidity driven, some of it QE and some of it just excess savings. Is there a disconnect between fundamental valuations and the valuation of the market? Probably in many markets. So could you see some crashes? I would say the answer is probably yes. A large part of the crisis, to my mind, could be from areas that we don't even understand yet. Today, when we talk shadow banking, the first thinking is trust loans and trusted loans in China, the hedge fund or the SPVs in the Western world. To my mind, we haven't begun to think about the consequences of what is coming on us the technology platforms. Today, blockchain is a small thing. It's not material in the big scheme of things. Jamie Dimon yesterday said he wants to fire anybody who trades in it. But the idea that you could have, forget crypto, virtual currency, I think that's very real. At the end of the day, what is money? Money is an instrument with faith behind it. Why do we accept a paper and go and be able to get value for it? Because the system believes the paper has value. So that can very easily transport to electronic money. Already, PBOC, the central bank here, Bank of England, several central banks are experimenting with the idea of issuing electronic currency, but it's fiat currency backed by the sovereign. You could very quickly get to currency not backed by the sovereign. So Bitcoin is a case in point. There could be tons of other virtual currencies. What are the implications of virtual currencies? What happens when the unit of account, medium of exchange, store of value is no longer backed by the full faith of a sovereign? Could you wind up with losing control of monetary policy? Could you wind up with excesses in the system? Certainly you could.
Jean talked about, sorry, did you want to add?
I was just going to add one thing from a perspective. I think this is definitely true for healthcare and likely true for most other industries, that large companies have more debt than they have historically because interest rates are so low. So when I think about the strength of balance sheets of companies versus 10 years ago and 20 years ago, companies are carrying a lot more debt because the interest rate, it's been so easy to get debt from the debt market. So I would think that's probably a hidden risk, that there's a lot of companies that historically haven't held debt that now hold debt, and so that's something I worry about and consider when I think about what kind of companies I want to invest in.
You talked about the .com and you talked about valuation. Let's take a look at the tech space now. If you take a look at the likes of Airbnb, valued at $60 billion, Grab at $6 billion, SoFi at $4.3 billion, there are a vast number of billion-dollar startups out there. How is the tech space different now compared to when the .com bubble burst? And do you see a bubble forming?
Well, I think there are a couple of important differences and there are some similarities. I think one difference is that in 1999-2000, a lot of the future was unknown. So many of the business models were hopes. One was advertising. So if you looked at Yahoo at that time or most horizontal portals, the belief was at some stage you'd be able to monetize it through eyeballs and advertising revenues. However, it was not clear that online advertising could displace television and print. Today, it's proven. So the fact that a disproportionate amount, in fact, I believe this year for the first time, total online ad spend in the US is going to be larger than traditional ad spend. Google and Facebook command the dominant amount of advertising revenues. So it's no longer fiction. It's been proven, it's real. People respond more to content and contextual marketing on your handheld device. Similar is the case for e-commerce. 20 years ago, it was quite unclear that people would actually switch to buying more stuff online. Today, it's definitely the case. By and large, people are very comfortable buying online. Logistics and delivery allow it to happen. So you're no longer betting on a dream. You're betting on something that's been proven. So I think those are important.
Proven and more mature. But do you see a bubble forming? Should these companies be valued at such elevated prices?
Yeah, so that's the flip. When I say that there's some similarities, the reality still is that people are valuing companies on growth and the belief that once you gain market share, you can drive yourself into oligopolistic or monopolistic situations and then command disproportionate profits. That's not going to happen for every company. By definition, only some companies, a handful of companies can create disproportionate profits. Meantime, you have slews of companies who are in the game. And it's quite clear most of them will not be able to get the future cash flows that justify the valuations that they trade at today. So the similarity is still there. A lot of companies are trading on gross merchandising value, eyeballs, total revenue, as opposed to true recognition of what the underlying profit dynamics of the company might be.
Biotech companies are doing better now than before.
Yeah. So I think that's a little bit different than the tech world, because biotech companies, the real value creation is prior to reaching the market. So when they're in clinical trials and once they reach the market, they are pretty soon profitable within a year of launching their products around the world. So it's a little bit different than the tech space where you're not earning money right away. But the real, what's happening now is the dramatic number of drugs that are in phase 1, phase 2, phase 3 clinical trials versus history. And how is that valued in the marketplace? I personally think what's happening in science and the ability to understand biology is going to change medicine dramatically. And some of that is discounted in certain stocks and in the market, but we're still so early. The tools I talked earlier, the tools that are available to understand biology really were only available since 2010. So I feel like we're in the infancy of this revolution. Al Gore talked about a revolution. I think we're in a biology revolution, and it's very early. And I think most of that is not yet discounted in valuations. But that doesn't say that there aren't some stocks that are fully valued or excited about a near-term event. But I think as a whole, there's a tremendous amount of value creation yet ahead of us.
Joachim, I want to talk about the pushback against globalization. Raghuram Rajan, the former governor of the RBI, called it a call of anger and a call for help. And some people have held globalization responsible for the loss of jobs, including Trump. Where do you stand on this, and what's the key lesson to learn from this pushback?
Well, I think that the role of globalization is partial, in the sense that we know that when you have gains of trade, one big question is how you share these gains. And in some cases, for instance, in the developed economies, part of the way to share these gains would be to support workers and others affected by the dislocation caused by more trade. And this didn't happen in many countries. So in a way, the gains from trade in some of the developed economies were not fully, say, distributed. And this is why we have part of this anger in some of these countries. I think also there are the reasons for this anger also come from other sources. It comes from change in demography that I mentioned. I think what Piyush mentioned is very important. If you get a model that is basically one of market power and oligopolist, or where you have rents, this is not the best way to distribute income. And in a way, because of technological changes, some of the most successful industries are exactly where this type of, say, industrial organization does exist. And this creates a new sort of questions on how you deal with taxation and other mechanisms for income distribution. So I think that we have to look of the consequence, for instance, of these new companies and the models in which they grow. The fact that in many cases, these companies have what used to be called a zero marginal cost. So this really creates a whole new economic environment that we are still trying to understand how best to react to it. And I think that in a way, this is more important than just globalization per se, in building some of this sentiment.
I just want to add to that. I mean, I couldn't agree more with Joachim. I think globalization is a convenient whipping boy. I think there are distortions from trade, but by and large, those can and could have been addressed by smart domestic policy. DPM Thurman makes the case quite eloquently that it's a domestic policy failure, not an impact of globalization that's been the cause of some of the distortions. I think the more profound question, though, is the impact of technology is vastly underestimated. I think the the good scientific, whether it's biology or whether it's data and AI, I think it's causing two important and very consequential challenges. One is secular deflation, as people say everything will be for free, but perhaps more important, jobless growth. You can see at the firm level, you can see at a macro level, they just are not going to create adequate employment. You're going to therefore wind up with this whole sense of inequity. You're going to get an accumulation of resources and wealth and power in fewer and fewer hands. And as you get to more oligopolistic, monopolistic structures, big tech, if you will, is going to be a challenge. So I think the cry of anger and the cry for help is less to do with global trade. It is more to do with the realization that we are hurtling down a path where what Harari in his latest book calls, we're going to create a useless class. Right? So from a working class, it becomes a useless class. And if you have a useless class, then you get to really profound questions that this conference is focused on. It's not just a question of redistributive economics. You can put a universal basic income, etc. But it's more fundamentally a question of meaning in life. What do people do? And do you wind up creating a super class which is sitting in a bunker in New Zealand and controlling and dominating the rest of the world? I think that's the cry of anger, concern, and alarm that you hear.
So take it 20 years forward. These days it's impossible to take 20 years forward when you can't take 2-3 years. But if you take it 20 years forward, where will the jobs be? Because essentially it comes down to jobs.
Let me allow to say one thing that I'm sure that many of you are familiar, is that if you have this glut in savings and in liquidity, and a lot of the things that generate more money, they don't require that much capital. It's important to find a new outlet of capital. And it just happened that one great possibility lies in infrastructure, and especially infrastructure in emerging markets and developing countries. It's not very easy to make this match between the savings and the investment opportunities. This is part of a core role of institutions like the World Bank, and more we are partnering with the private sector to channel these. But you also see the same, the other side of the coin, for instance, the case of China, and where, of course, the surge of investment that you saw just after of the crisis cannot continue. And because there is a lot of planning, this is one of the drivers, of course, of the Belt and Road, which is how you can use this perhaps excess saving in a productive way, in a way that creates wealth around the globe. So either you see from the point of view of pension funds, insurance companies, or you see, for instance, the case of China, which of course, the bigger it is, more contributes to global savings. I think this is the core issue in terms of creating new income streams for pensioners and so on, but also new opportunities and new sources of growth and I'd say productive use of this capital. And I think that we have to more and more concentrate which mechanism, what kind of global coordination could help to do that. In addition of all the consequences in terms of climate, in terms of population migration, that investing in smart infrastructure can have for the next 20 years.
No, I think it's quite clear there'll be some sectors you will see growth in. Right? So again, the previous speaker, Al Gore, spoke about renewable energy and how there are 10 million jobs in solar. There'll be some infrastructure investments. There's some new kinds of professions, data analysts, data scientists, design engineers. But I think it is quite clear that in aggregate, there are going to be fewer jobs as we know jobs. In fact, I think if you think about the construct of jobs today, large corporations, large companies employing large amounts of labor, in truth, that this is not a concept which has been there forever. This is a construct that got created with the Industrial Revolution. Henry Ford assembly line. We put large companies together, and then Max Weber came up with the bureaucracy. So between the assembly line and the bureaucracy, you created companies and jobs as we know them. You go back 200 years, there were only small-scale industries, guild labor, and apprenticeships. I think the internet and technology today, because it allows you to scale and be instantly global, will lead to a world where you will have fewer and fewer traditional jobs as we know it, and you will go back to a world of small-scale individual enterprise, what's today called the gig economy.
What
I
will
think you
happen-
will have to drive to a lot more entrepreneurship and self-sustaining employment as opposed to organized labor as we've seen before.
What will happen to the bankers? Because when I spoke to Vikram Pandit yesterday, he said that 30% of the banking jobs will disappear in 5 years. And if you take a look at a Citi survey report, it said that 1.7 million jobs in banking will be lost in the next 10 years. So where banking is concerned in the next 20 years, how will the jobs look like?
The jobs are going to shrink. I mean, so I said, it's a given. Jobs are shrinking in my bank already. I need less people in the call center because the chatbot handles it. I need less people in the front office because we automate all the cash and this thing. In fact, cash is disappearing. Fewer people walk into our branches, so we need fewer tellers. So there's no question jobs are going to reduce. The function and the convenience and functionality for consumers is going to improve, but it's not going to be through job creation.
I'd say that, well, two things. One, it's very difficult to project this. When ATM was invented, people thought that tellers would disappear. Still, there are a lot of tellers, although in the last 5 years, say, banking in a way has changed, especially for the millennials. But there's more in terms of counseling, even with all the artificial intelligence in finance. And as people get more money, the type of job will change, but doesn't mean that finance will necessarily shrink. But when I think about 20 years ahead, I sometimes have this image that if you think about 19th century, it was chemistry. If you, or engineer perhaps, if you think about the 20th century, we'll think about physics. And of course, computing. Now we are talking, I think Jane has really the key. It's by technology and associated with AI, but AI is mimicking a lot of things that are in biology. And when you think, even for the consumer experience, you're going to see that more and more what we will be seeing is systems that will be looking at you, predicting your behavior, providing things ahead for you, subtle comforts. I think there's where you're going to see growth in terms of industry. And more generally, I mean, living longer, having more or less illness. These, with everything that Al Gore said about new sources of energy and how to stop the climate change, you'll be the two biggest sources of growth in the next 20 years. And if you get it right, you'll be in a good shape. If not, big trouble.
Can I add just one thing to this topic? And I don't disagree with anything about what jobs might happen, where jobs might go. But one thing that's very important that probably can't be overlooked is what happens with tax reform in the U.S. So when I interact with my companies one-on-one, the most important thing on their agenda is tax reform. There's been a lot about the Affordable Care Act, but the companies, what they're most interested is not so much the 15% tax rate. They'd be quite happy with a 25, 26, 27% tax rate. They just want free access to their capital. And so I think if the Congress can get tax reform done in the US, which is such an important economy, it'll be very interesting to see then where all that free access to capital and how that's invested in the next 10 or 20 years.
Before I open the discussion to the floor, just an answer from all three of you. What do you see as the biggest risk in the next 20 years? Piyush?
I think the risk of technology. I think technology can be a tremendous force for good. I think it has also got the potential to do a huge amount of damage because it can change this whole context of joblessness, equity, role of human beings. Historically, we've been okay. We've let technology lead the way, industrial revolution, steam engine, etc. And human society has been able to remodel itself over time. I think this time we really need to be thinking hard about the new rules for the new age alongside the change in technology. Otherwise, I think it might be too late. I think these cries for anger and helplessness are the tip of the iceberg. If we are not thoughtful about how we balance the technology changes that are on us with thinking about the social impact and thinking about the rules for society, I think we could wind up 20 years from now with significant problems.
Jane?
Yeah, so I'm going to go take it from a demographic point of view, because the world is aging at a level where there's going to be more people over the age of 75 in the coming decade. And when I think about it from a healthcare perspective, and I think it has broader implications than just healthcare, it feels like we've been in this natural demographic curve over the last 20 years of the aging population, and it feels like we're about to hit a tipping point. And so I think that leads to all kinds of questions. So if you have Japan in the next decade, it's going to have over 20% of their population over the age of 75. That has just enormous questions for societies. China's behind. China has a rapidly growing, but Japan, in terms of the aging population, will age the fastest. And so I think it just has a tremendous amount of implications for what governments do because of the social contract with healthcare around the world. And how do you fund healthy lives over the age of 75 while still investing in the rest of the economy? So I think it's a question I think about a lot in terms of how they'll pay for healthcare and other services and goods that are used by people over 75. I think it's a really important question to start thinking about.
Okay.
I'd say that the biggest risk is if you fail to have a global coordination, international coordination, because a lot of these things to address effectively require to take, say, advantage of comparative advantages and cross-border investment and so on. When you're talking, for instance, aging society in some places, you have other places where you still have young societies. How you can invest so that you have a huge response. If you think, for instance, the 80s, one reason why the US responded so well to some fiscal policies, because you have the bulge of the population that age 40, 30 something. So anything will lead to a huge reaction. Now, with the aged society, including in the US, and especially if immigration slows down, the consequences, even of tax reform, could be different. So you have to think globally and really take advantage of the differences that we have across the globe. And so this coordination, G20, whatever mechanism, multilaterals, I think will be more and more important to address crises that, 40 or 50 years ago, there was this idea of the global village, because we know what will happen in every country. I think first, global village has changed the idea. We became a village because in a village everybody knows what everyone is doing. It's a bit like today with all this electronic surveillance. Everybody, and especially some big companies, knows everything that you do. So we become a village in this sense. But also, yes, everything, the globe that's shown in the first talk today, it's a small place with a very thin atmosphere around it. So we need more and more global coordination.
As in, I'm going to cheat, and the second one is obviously the climate change agenda. I do think that slide of Al Gore's, the 1 degree difference between ice and water, that's actually quite important. It's interesting that most of the Paris Accord commitments, even the 2030 or whatever, but many of them are back-ended. And many of the 2 degrees thing is 2050 and beyond. I think we're still leaving a massive problem for the next generation if we don't get that right.
On that note, let's take questions from the floor, if there's any. Mike, are you here? No questions from the floor? Think of one. Let's carry on our conversation here then. In terms of, we've been talking about risks for the emerging markets going forward. I'm wondering if the unwinding of stimulus will pose new vulnerabilities for emerging markets. Piyush?
Some perhaps, but I think the magnitude might be overestimated. First, if you look at the bulk of QE, certainly the US QE, the largest portion of the money went back into the Fed coffers. 80-90% of QE went back into the Fed coffers. It did not actually circulate back into the real economy. There's several billions which came into the emerging markets. but it was certainly nowhere near like the $4 trillion of QE that got created. Our own assessment, in fact, most people believe that, second, the interest rate impact of QE was anything between 15 to 25 basis points. So a large part of the impact was policy rate driven and not QE driven. So if you look at potential for unwind, you could see some impact, but again, it's instructive that so far you haven't even seen the degree of panic that you saw 2 years ago with the taper tantrum when Bernanke first announced that there might be a dial back of QE. So I think the markets are pretty much priced in a certain degree of flow back out of the system. There will still be some choppiness, but I don't expect it to be as consequential as people imagine.
Joachim?
I think that the extent to which first commodity prices have come down quite substantially compared, for instance, the time of the 2013 to 2011. This means that a lot of countries have already adjusted, but we cannot be complacent. There are risks. There is a certain level of corporate leverage around the world, but I think that just the adjustment of monetary policy in the US also is being done very carefully with a lot of announcements. So I think this should not be say, prime source of financial dislocation. I think credit worldwide, including in Asia, is something to be watched, but I think most authorities are also quite cognizant and have taken gradual, careful steps to rein in shadow banks and other sources of potential instability.
So I think the bigger risk, Haslinda, is bond yields. And while those could be predicated from QE unwind, monetary stimulus unwind, I think it could be driven by several other things. I think the jury is out right now on the cause for low inflation and therefore low interest rates. Is it the Larry Summers view, which many people now subscribe to, that you have a form of secular, well, maybe stagnation, but secular issue, which is really driven by technology and continued deflationary pressure? Or is it cyclical? And if you figure it is cyclical, then you could argue that inflation can start popping up very quickly. We already had record low unemployment, and so far, while wages haven't started going up, there's no, maybe the Phillips curve is flattened somewhat, but it is not inconceivable that you start seeing much sharper wage increases, in which case it starts flowing through to inflation. And then you could have a Fed rate structure, which is much sharper policy rates, which could then take the 10-year back to 3.5%, 4% in the extreme case. I don't think the world is ready for that because the amount of incremental leverage and credit in the system is quite large.
One question from the floor before we wrap it up, please.
Thank you. He's picking up on.
Why are you picking on me, Henny?
Picking up on your last point, many people are concerned about the fact that a lot of the new products in asset management have never been tested, in a rising interest rate environment. We have ETFs where the derivative, the ETF, far exceeds the underlying. There's significant questions about the pricing as well as the liquidity in fixed income ETFs and the danger of flash crashes, incredibly one-way momentum-driven markets. Everything feeds on everything else until it suddenly stops, whatever the catalyst. How concerned are all of you about that? I'm just picking up on your last point, so I'd love to have your input as well, Jean. Thank you.
I noticed when you walked into the room, and that was after I'd already made that point, which is that I think the excesses of credit are real. And as society, we never learn that there are some challenges with excesses credit in the system. I think some of the products today are not in the regulated banking space. So, ETFs and a lot of the stuff are some of those. And it is true. Many of credit models, many of products have not been tested. And I think if there's a sharp rise in rates, you could see some of that. The other issue is increasingly stuff is all being driven by AI and algorithmic technologies. You're already beginning to see sharp gapping in rates and prices because algos work like algos work. And sometimes, therefore, you have a complete lack of liquidity in the market. So could you wind up with more crises which are unimagined today because of the way technology functions in a situation where rates are popping up all over the place? Certainly, I think that's possible.
I think this question is an important one. I mean, at the FSB, the Financial Stability Board, we've been looking at last year. There are a couple of papers that actually issued with some guidance. And part of the problem is that some of the structures promise high liquidity based on the underlying assets that actually are seldom traded. So even the pricing in a moment of crisis could raise problems. So there were some guidance for supervisors in terms of watching if the liquidity is a match the real nature of the assets. And I think you have to continue to watch this carefully because, yeah, it's complicated to know exactly how the long term of the curve might react to any change in policy. But I think there are instruments that could control that, except that some of these funds are so big that it's hard to predict. So they always have things that we have not experienced before.
So maybe just one comment on that. As being an investor who invests in the markets every day, I really feel it. I really feel the impact of ETFs and when companies report earnings or companies report news. You know, the way stocks react is completely different than it was 10 years ago. And so what I do personally then is to lean into that liquidity. So tweaking around the margin, leaning in, leaning in and providing liquidity in that situation. I think, big asset owners have to continue to do that. But I feel it. I feel it every day that, things aren't acting exactly how they act. I think in the end, though, it comes down to fundamentals. What are assets worth? And over a long period of time, those assets will be worth what they're worth. But there is a lot of short-term impact from those instruments.
All right, ladies and gentlemen, on that note, please join me in thanking Piyush, Jean, and Jochen.
Thank you for joining us.